Hello and welcome to our live episode of The Upside. I'm Nicole Correale. It's been a whirlwind week for the stock market, and it's leaving investors on the edge of their seats waiting to see what unfolds next. The latest CPI print, fresh record highs for indices, and the Senate's confirmation of a new Fed chair topped the list of key market drivers. So what might it all mean for you? You sent in your questions and we've got the answers. Joining me for another episode of In the Chat with Denise Chisholm is the one and only Denise Chisholm, Fidelity's Director of Quantitative Market Strategy. Welcome, Denise. It's a pleasure to see you.
Hi, Nicole. It's great to be back.
And before we jump in, a quick note to our viewers. If you have a question for Denise, drop it in the comments below. We are live today, so I'd love to get your questions in live to Denise. And again, before we get into those audience questions, I'd like to start the discussion by unpacking some of those key market drivers I mentioned at the beginning. So, inflation rate in the United States increased to 3.8% in April from 3.3% in March of 2026. Core CPI ex energy and food is at 2.8%. So this is the highest inflation reading in about 3 years. And it's creeping higher, but still below 4%. And I know, Denise, you've discussed in previous sessions how between 3 and 4% is actually the sweet spot for equity returns. But you've also pointed out to how the volatility of inflation is more important statistically than the number itself. So are you concerned with the latest CPI print? Is this another one of those knee-jerk movers that you've also talked about? What are your thoughts on the latest print?
Yeah, when you look at the data, I mean, it's interesting and very akin to what we experienced with tariffs last year. So energy price increases do act like a tax hike on the consumer, which means that they tend to be temporary in nature and not affect the way the Federal Reserve actually looks at inflation. So the biggest risk is that ultimately oil prices stay where they are, and that price increase gets passed through into what they call core inflation, which is the rest of goods and services pricing. So we can look at that historically and wonder whether there's a typical probability of it getting priced in. And the interesting part is even where oil prices, where they are right now, up 60% over a 6-month period, if you look at the other times that that's happened in history, actually has happened quite a bit. Usually in economic recoveries, not necessarily supply shocks, but it tends not to pass through to core inflation. And in that data, the print we just saw, if you take out shelter, which is akin to its own supply shock, much like that we're seeing with oil, and we look at the core CPI ex shelter, we're actually still just above 2%, which is not to say that inflation isn't a problem for the consumer and affordability isn't a real issue, but it is to say that if the Federal Reserve reacts on it, they run the risk of creating a bigger problem because they can't, through interest rate hikes, solve any supply side issues. So I think it might be more of what we saw with tariffs. Unless we see a lot more price pressure in terms of oil, you might be surprised that this isn't going to filter through into overall inflation because the US consumer doesn't have any more money like we saw in like 2021 when the stimulus was there. So without any more money, your marginal propensity to consume goes down, and corporate America's marginal propensity to price also goes down, which is why you saw a price hike in terms of goods when we saw the tariffs being enacted, but we didn't end up in a situation where all prices rose. And we might be seeing a repeat of that movie this year where energy prices are rising, but we might not see it filter through into broader inflation, which might mean we stay still in that sweet spot of core inflation between 3 and 4, which is actually a good spot for the S&P 500.
Okay, well, that leads me to my next question, which you've kind of touched on. What does this all mean for the Fed? How might they move? And the Senate did confirm a new Fed chair, Kevin Warsh, former Fed governor. And a lot of people are trying to see where he's going to go with the next, I guess, rate decision. He used to have a really hawkish stance, now maybe a dovish outlook. And given the latest developments, anything is game. But like you said, it might not be so terrible. They might not have to hike. What are the markets pricing in right now for the next rate move then?
Boy, it's moving all over the place.
Yeah.
So I think we priced in a hike and then we unpriced a hike. And I think we're pricing in the potential for a hike again. Now, the interesting part, and I'm actually in the process of writing up this note right now, is I think that there's We've talked about this a little bit before. The why behind what the Fed does is really important. So when you focus on oil prices, again, back to that data and the price spike that we've seen, if you look at oil price spikes in the past, the bigger the spike in oil, the lower the odds that the Federal Reserve, historically speaking, hikes. Because I guess you could point to the data and say, well, maybe the Fed usually sees what Denise is saying in the data, which is it acts like a tax hike. So that's the last thing they want to do. But this is the interesting part. At the same time, if you've been watching the core capital goods or the manufacturing part of the economy, and if you're seeing the inflection that we're seeing there actually are some really good leading indicators to growth. Now, if that sustains itself and we are in the process of a recovery and a continued rebound, that does increase the Federal Reserve's likelihood of raising interest rates. But if they do it because it's a reflection of growth, historically speaking, the equity market has very little problem with it, as long as it's matched with growth. So if you fast forward a year and you say, well, the Federal Reserve made a policy mistake and raised 25, 50, 75 basis points, and we weren't seeing growth, that tends to be a negative risk reward for the market. However, if we fast forward a year and they do 25 or 50, but we're seeing an economic rebound pickup, job growth picks up, core capital goods numbers picks up, profitability continues strong. When you look through history, that usually isn't a headwind to higher stocks in the future.
Well, speaking of growth, wage growth has been decelerating for a while. And a new data headline is that for the first time in 3 years, wages are no longer keeping up with prices. So real wages are falling. Is this of concern to you? At what point does it start becoming a recession risk?
Yeah. So it's interesting. So 2022 was the only non-recessionary period we've ever seen where real incomes fell as much as they did. It was such a unique period. And in some ways, you can call it sort of a full employment recession, which is where everybody stayed on corporate America's payrolls, but you actually lost purchasing power. And to your point, because of the spike in oil prices, what you're seeing right now is real income growth or real wage growth. I shouldn't say real income growth because that includes jobs, but real wage growth is negative this month. And I do think like this operates in terms of an interesting dynamic in the market, because you would think that that would naturally be problematic to the market, but usually you see a rebound. And the interesting part is when real incomes are negative, this stymies the ability to see a generalized rise in the overall level of inflation. And I think that that's what's been different this time in 2022 and right now versus the 70s and 80s, where you truly had a wage price spiral, where in the 70s and 80s, when you study history, if you stayed with your job, meaning that you kept your employment, by and large, you kept pace with inflation. That has not been our experience this time. And if that's not your experience, then it's really hard to get a generalized rise in the overall price level of all goods and services. So it's an odd situation where, the US consumer is certainly under pressure, but when you look at unit labor costs as it results in sort of corporate America's profit margins, that's what's ultimately driving the S&P 500, which is that durability and profitability. The question is how long it continues to this way. So when you look through history, you will find that real wage growth from a negative perspective tends to be temporary, because if profits are persistent, they are the leading indicator to more employment. And that's the sort of self-fulfilling prophecy of what is the economic cycle.
Okay, so let's get into some of these audience questions that are coming in. And one of them here is, speaking of oil, let's start with this one. Do higher oil prices affect international and emerging markets differently?
Without a doubt. So US, first of all, it affects the US very, very differently. And I put out a bunch of notes on the topic that you can see it visually, just how different this is versus the 70s and 80s. And you can see that, energy goods and services, a percentage of the US consumers' income is much, much less than it was in the 70s and 80s. Our oil intensity as economy is way down relative to the 70s and 80s. Therefore, the price spike that you're seeing has less of an impact because we're just much more efficient. And this is the key difference this cycle, the US is, for the first time in history, a net exporter of energy, goods, and services, more or less. And that is not true outside the US. That is certainly not true in Europe, which is very much affected by energy input costs, as is Asia. So if you sort of step back and say, well, this cycle might have been a different cycle in that there was a big valuation gap between international stocks being cheap, US stocks being expensive, and we might be at the point of which, at least you could make the argument, that maybe there are some growth factors in play for international economies, meaning that they have to spend on defense and they have to create their own barriers in terms of their own economic growth. So maybe growth gets a little bit better relative to the US and that valuation gap can close. I think that the oil prices being where they are, if they end up being sticky, really throws a monkey wrench into that argument. And outside the US starts looking, in my work, more and more like a little bit of a value trap. Because if that gap in terms of growth doesn't close, if oil prices stay elevated and it affects the US a lot less than the rest of the globe, then that valuation differential, at least historically speaking, hasn't been enough to allow international stocks to outperform their US peers. So this might be a very different situation relative to what we thought might happen just a year or two ago.
And that was going to be my follow-up, is that, does this tilt the advantage back to the US and maybe put a ceiling on, where international markets can go, given that they are more affected by the higher energy prices?
Absolutely. And I would argue that that was probably already in place. So the way I looked at the data was, again, when you sort of sweep it and you say, well, let's look, every time you saw this gap between international stocks being this cheap versus US stocks being this expensive, and you bought it, did international stocks end up outperforming their US peers? And they did about 30% of the time, right? Which tells you 30% is not like something like 70% that you would want to, I would say, bet on as a critical driver. So valuation in and of itself tends to actually predict the fact that growth isn't turning. And so far, even before the energy crisis, I never saw in my data in IFA, in Europe, even in emerging markets, that you were seeing a sustained inflection in growth relative to the US. So yes, growth picked up in all of those indices, but it picked up more and is still picking up more in the US. And that's even despite energy. So energy might be an incremental headwind off of something that, to me, didn't already look that different relative to history.
Hello, everyone. Just a quick break in the show to let you know that Fidelity is giving away branded hoodies. To celebrate over 2 million Canadians choosing Fidelity, you can enter for your chance to win at fidelity.ca/hoodie-contest. Performance is more than a number. So choose performance, choose Fidelity. Now back to the show.
Another question we have here from the audience is, a significant share of the index's gains is being driven by a relatively small group of AI-linked and mega-cap stocks. To what extent is this concentration skewing the broader market's performance? And is that true?
Okay, so a couple of points to this. So
Yes.
It depends on what you mean by that. So I find this ironic when we look at the Mag 7, right? And those are the 7 we usually talk about. Over the last year until very, very recently, what you saw was those 7 stocks underperformed the S&P 500. So I always find it interesting where people, I think, confuse a little concentration in terms of market cap with relative performance. So those stocks lagged the S&P 500, which meant they weren't leadership. And we're seeing continued rotation into what those top stocks are. And even remember, we used to go from FANG to the Mag 7 to then, the top 1. And that rotation is actually very healthy. Now, when you look at the concentration of markets, so you can definitely chart that, and we have it going back to the 1930s in terms of the number 1, 5, 10 stocks being a proportion of the market cap of the S&P 500. And that is a very different trajectory than what we saw over the last 20 years, to your point on concentration. Doesn't necessarily mean that they were the only ones driving the market higher, like I said, over the last year, but we do see a concentrated market. From my vantage point, what I try and do with data is, let's not assume that we know exactly what that means. We can look at it in history because we saw concentrated markets before. They were just in different sectors, energy, industrials, and materials, actually back in the 30s and 40s and 50s. And what you find is, if you sort of quartile out concentrated markets, you don't end up with any meaningful differentiation in returns. Meaning that, you said something like the market's concentrated, so you might think that, well, that makes it riskier. you can't prove that mathematically, which is a different way to say, look, concentrated markets can stay concentrated for a very long period of time. The final thing that I will say on this topic is the interesting one, which is the Buffett quote, which is to say that, look, diversification protects your wealth, but concentration tends to build it. So how you think about concentration really depends on where you are in terms of the risk tolerance. The longer your time horizon, the less you want to be fearful of concentration. The shorter your time horizon, the more you want to protect against those downturns because you can't afford it, from a money perspective. That's where diversification comes in. So from that perspective, it comes down to your personal risk factor and your personal time horizon. But concentration mathematically in and of itself, I would say, is not a particularly critical risk factor.
Okay, jumping to our next question. The SEC has proposed allowing companies to shift from quarterly to semi-annual reporting. If adoption were widespread, how might that change the way investors interpret data and assess market signals? And would it materially impact your process?
Probably not for me. I will say, there's so much data out there. I think I was just talking with a colleague. I think I have in my folders, and I don't look at this every day, but I have 10,000 pieces of data that I tend to explore and look for anomalies, and then critically discrete look at those variables and to try and find patterns. So if you went from every 3 months to every 6 months, we see that in some Japanese companies already. So it doesn't really change trend. What I usually do is look at things for longer term trend. I find maybe the potential for going from 3 months to 6 months or even longer, an intriguing study because there's a trade-off, right? So the reason why we picked quarterly is just because, maybe you get 4 shots a year, it's transparent, you see more of the company's individual businesses, and through that transparency, you then feel more comfortable as an investor. But there's a trade-off because we don't really know how many people do this, but there are certainly some companies out there that manage their financials to the quarter. And that's an inefficient use of resources. So again, there's this trade-off between transparency for your investors and the ability to have more flexibility to potentially run a better company and offer more profitability over the long term. Now, what proportion of companies do that and don't do that remains to be seen. That part we don't know. So yes, we can talk about the lack of transparency moving from 3 to 6, but we also should at least consider the option that it also might preserve future profitability in a way that hasn't been preserved in the past. So there could be upside that I don't think people are considering when they think about the narrative.
We got a live question in here. Given the price volatility for oil and gas companies, what is your sense of duration? Are we seeing higher for longer? And would oil and gas companies surprise us with profits? Or are these prices short-term trends?
So I don't know. I don't know the answer to that. I find it interesting when I look at the oil market. So 2 things. I would say that up until this crisis, there was a lot of excess supply in the market. And you couldn't see it in inventories so much as you saw it in OPEC cuts in terms of production. So I call that statistical excess capacity, which meant that to the extent that prices went up, there was productive capacity on the sideline to make money from that. That's the part that I find intriguing mathematically when we think about, even if we end up having to shut in some resources, it's going to be a while until we can get those back online. So therefore, the oil market might be in a supply deficit for longer. Won't that mean higher oil prices? Not necessarily historically. So if you perfectly predict what inventories are going to do for the next year or 2, that doesn't accurately predict price. Half of the time it goes up, half of the time it doesn't. Why? It's because of this definition of excess capacity. So that might create a bigger lid on oil prices than I think many are expecting. You're already starting to see some increases in production out of the US. So that's the excess capacity. So oil prices might indeed stay higher than they were and even be higher for longer. They may also be capped by additional supply. High prices tend to cure high prices in that it ends up calling supply. Think about before the financial crisis with $150 oil. OPEC, I think, made one of the biggest mistakes in a historical study where they kept oil prices high for long enough that they created economics in the shale producers, in the Canadian oil sands. So if oil prices do stay elevated, don't underestimate supply to actually meet the challenge. The last thing I will say, and I think that this is important, and I wrote about it in my notes, is because I know people think that price spikes are very correlated with recessions, and they are. We certainly saw that in the 80s. We even saw that in the financial crisis. But I think that the important nature is that incomes have grown over that time, as have corporate profits. So if now you rebase oil prices, your $100 oil we have now, let's say, I haven't looked at the spot today, but what would it have been to create the same kind of corporate profit stress in the 70s? It would be almost $1,000 a barrel. Which is a different way to say, look, I don't know what oil prices are going to be, but if they're higher for longer, it might be more absorbable than you think, because they're a lower portion of the consumer's goods and services, they're a lower portion of our net worth, and more importantly, for an equity market investor, they're a lower proportion and lower pass-through to corporate profits as well.
So lastly, here, another live question that's coming in. You are so great with you frequently come on Connects and you have your top 3 and your bottom 3 sectors. And this viewer, so this is a little more nuanced. It's about, she may not be, go into about, has the US government actually legislated any changes to Medicare funding, but the healthcare industry as a whole, how is that looking to you right now? And how is that faring in today's environment?
Yeah, it's interesting. So when I look at the data from a sector perspective, you will see healthcare operating margins peaked in like 99, 2000. Maybe you could squint and say it was a little higher in 2003. But after that period, they've been in a secular decline. So when you look at the healthcare industry and you say, okay, I have perfect foresight, I think the market's going to go down 10% over any course of any 6 months, you will see healthcare act defensive and outperform the S&P 500 on average. Outside of that, it tends to underperform at a bigger pace. There are points in time where much of the bad news might be priced in. I talked a little bit about that over the last, I would say, 6 to 9 months, where it was at trough levels of growth, or bottom quartile levels of growth, which meant earnings were quite poor and the stocks were cheap. You usually do get a window of a positive risk reward. And I think that we've actually seen that and also potentially have seen that pass. So the stocks aren't nearly as cheap as they were 6 months ago, and earnings growth actually rebounded, taking us out of that potential buy zone. So healthcare as an industry, despite the demographics, more on the margin trends, just gets less profitable every single cycle. And I think that that's a headwind that, again, makes it a little bit of a value trap in my work. If you bought it when it was cheap, does it increase your odds? Not necessarily. So I think that the risk reward is still negative, and I'm certainly still interested from my vantage point in those economically sensitive sectors that I've talked about on Connects, like technology, industrials, parts of financials, and parts of consumer discretionary.
Okay, and just to end on, we have a last minute question coming in that I'd love to get. So thank you everyone for sending in your questions. What are the risks of recession from your vantage point?
It's always a great question, like Denise was going to go bump in the night, and I'm not going to answer it. I'm going to dodge this question only because, look, the risks that I could quote you are the same risks you read in the newspaper.
Right.
The biggest problem that I see in the market is that we actually correctly quantify all the risks. We get it right. We completely nail it, and we get the market reaction wrong. I see that as the biggest risk. And I say that because, and I wrote a note on this if anybody wants to go back to my LinkedIn, the bottom in the market from 1976 to 1985 was 1978, before either of the two back-to-back recessions happened in the US, before interest rates were 15%. And I think if that doesn't show you the power of the equity market being a discount mechanism, I'm not sure what does. I mean, that was the biggest risk I see. Like, imagine you called it completely correctly. Hey, we're going to have 2 recessions. I want to wait. I want to sell before either of those happens. I want to wait until the end of that last recession, right? We finally start creating jobs again, and I'm going to buy back then. If you absolutely nailed it, what'd you miss? 40% nominal returns, almost 10% real returns. That's the risk that I see. And I say that because we have two pieces of evidence that when we started this year, I actually thought that equities were already discounting, I won't say a hard landing, but something that goes bump in the night already, which is to say that the fear in the equity market was much, much greater than the fear in the credit markets. And that has been sustained this cycle. And you saw that in the multiple contraction that we just saw, right? Earnings growth has been fine. And the sell-off, stocks got a lot cheaper. That only happens 5% of the time. And the 5% of the time that happens, you actually have a really good risk reward. So what did the equity market already discount? I think that that's worth consideration before we think about all the risks. Because if you just think over the last 5 years, all the things that went wrong that were very different this time, they're always very different. And equities are up 70% over the last 5 years. And think of all the unique situations that we thought couldn't be powered through. So in some ways, I think the bottom line is almost, never underestimate the power of corporate America to retain their profitability.
And I implore everyone to check out Denise's LinkedIn note that she puts out. It is fantastic and pretty much explains what you just said again. So thank you, Denise, so much for joining me today on The Upside.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.